What are the best investments to make during a time of inflation? That's what I'm going to dive into in this video. Where should you be putting your money in a time like this? Because this has an opportunity to eat away at the money you have in the bank if you just leave it there while inflation is chipping away at those dollars. Or you have the ability to actually strategically invest in the right things we're going to cover in this video that's going to allow you to make an even better return. Some of the best fortunes are made during times like these, and I'm going to cover that in this video. So the first investment is one that you may not actually know about, and this is actually investing in Series I bonds. Now, Series I bonds allow you to invest in inflation adjusted bonds that actually give you the ability to earn interest rates based on inflation benchmarks. So what does that mean? That means that you're going to be earning interest on this bond, on the money that you put in, based around the current interest rate that's determined twice a year. Now, there are a few limitations to this. You can only put $10,000 into these inflation I bonds. You do have to buy it directly from the Treasury. But what this allows you to do is get very limited, virtually risk-free bonds, although we're going to talk about the downsides in just a second, so it's really important. Also, this entire video is not financial advice. It's important to share that as well. And so these inflation-adjusted bonds, these I bonds, allow you to put in a certain amount of money and then actually make returns based on what the current inflation rate is, which is really valuable if you think about it. Now, the current I bonds are yielding 9.62%, which is going to allow you to earn that as a return on an annualized basis. Now, they set these rates twice a year in April and October, and each time they set these rates, you have those rates locked in for the next 6 months. That means if you put money in right now, you're going to be able to earn that 9.62% APY over the course of that 6-month period. Then in 6 months, what they'll do in that October timeframe, they're actually going to reset the rate based on current inflation data. So maybe ask yourself, well, that sounds almost too good to be true. What are the downsides? Well, the reason it's so valuable right now is because we're in a state of high inflation. Normally, when inflation rates are 1 to 2%, which is what they're looking for on average, then you're only going to get that 1 to 2% return, which barely outpaces other investments you can make, even standard bond yields. However, in a time like this, you actually have outsized returns within these investments. You have that 9.62% and then whatever it turns into in October when the rates reset again. And so there's another element though too that's important for you to understand. The first is that when you invest into this, you are locking up those funds for at least 1 year. So you put it in for 1 year, you can't take the funds out for a year. Now, between 1 and 5 years, if you want to take the funds out early, after 5 years, there's no penalty. But between 1 and 5 years, you can take the funds out with a 3-month interest penalty. So whatever interest you earned for those last 3 months, you're going to sacrifice those to take it out before 5 years. So you can get the funds out within 1 year. That first year it's locked up. Then between 1 and 5 years, then what you're going to do is lose the last interest, the last 3 months that you earned. And then after those 5 years, you're going to be able to take the money out with no penalties or deductions at all. And so those are just a couple of important things to make sure that you understand when you do invest in I bonds. Now, you can buy the I bonds directly from the Treasury by going to Treasury Direct. We'll post a link down there below. Now, the site looks a little bit old. It's a government site. I mean, hey, I'm not going to judge that though. It's a great program. And so what you could do is go in and buy those Series I bonds directly from Treasury Direct. Now, there is a limit of $10,000 per person. There's ways to actually increase that limit by deciding to take your tax return money in an I bond, but that's for another time. You can take a look at the details within their frequently asked questions, but in general, you can deposit electronically $10,000 per person directly into these Series I bonds. And right now, because they reset these rates in April, and because inflation is so high, you are earning 9.62% for that period of time until they set the rates again in October. And so at that point, they'll take the current inflation rate, which again, I can't predict here whether it'll be higher or lower, where it will be. Whatever that inflation rate is, that's what you'll get for that following 6 months, and they keep resetting that every 6 months. So this is the first place that you can put your money. It's better than keeping it there in a bank account if you're not gonna use it for that year. Here's the important thing. You gotta make sure you set aside an emergency fund. You have that accessible. You also have the cash flow that you need within your business or whatever you're running, right? You wanna make sure that you at least have 3 to 6 months of your expenses already set aside. But then what you can do is start looking at investing in things like these I bonds to make sure that your money isn't gonna lose value in the background. So you may be asking yourself, where should I put my money if I'm looking to invest in the stock market? Well, I'm gonna give you 3 different portfolios that you can consider investing in. The 2-fund portfolio, a 4-fund portfolio, and a 6-fund portfolio. Now, in general, the basic rule that's generally recommended is to invest your age in bonds and the rest in stocks. And then with that amount that you're investing in stocks, dividing it up between the different investment or ETFs that you're looking for. Now, if you're unaware of what an ETF is, an ETF is an exchange-traded fund that actually has a variety of different stocks within one fund, within one ETF. And so what you're able to do is invest directly into that and then invest in the entire basket of stocks within it. So if you're investing in VTI, which is one of the ones we're going to be talking about, you're investing in the total US stock market via Vanguard. So what you want to do is you want to find a broker that you like, Vanguard, Fidelity, a couple popular examples, and then you're going to invest specifically into these different ETFs depending on what your strategy is. Now again, I recommend consulting a financial professional if you're really looking to build this out, but here is what I would look at and what I do with some of my investments. And so the first is to take a look at a 2-fund portfolio. The main 2-fund portfolio is VTI, which is the total US stock market, and BND, which is the total US bond market. And so if you're following that basic principle of investing your age in bonds, which was popularized by Jack Bogle. Now, Jack Bogle was the founder of Vanguard, and there's actually become a cult following around him called Bogleheads. Now, I'll link to the forum down below, but it's an entire forum, an entire wiki that's dedicated to his investment philosophy that bases around having just a few fund, index fund portfolio that's gonna allow you to compound your wealth over time. If you look at the investments that you have and you look at how valuable it is to compound your wealth, if you take a look at a compound wealth income calculator, you can see how fast your money is able to grow, even at just 7 or 10% annual return rates within the stock market. And so what I'm gonna do is cover these 3 main types of portfolios. The first is the 2-fund portfolio, where you're gonna invest your age in bonds, which you can put into BND, which is the total US bond index. Then from there, you can take the rest of it and invest it into total US stocks, VTI. Now that is the index fund that buys up and covers the total stock market. That way, you're gonna be able to grow your income as the US stock market grows, while also having those bonds in the background. Now, in general, they recommend balancing your portfolio at least once a year, if not more. So if your bonds become a greater portion of your portfolio than stocks relative to your age, then you'll want to buy more stocks, maybe sell some bonds to buy stocks, or vice versa. But in general, you want to keep putting money into this strategy and dollar cost averaging in over time. So if you want to spice it up a little bit and create a 4-fund portfolio, what you can start to introduce is total international stocks and emerging market stocks. Now, there is some back and forth data on whether or not international versus US is going to outperform. And actually, recently, the US has been much, much stronger than international and emerging market stocks. But there are people out there, for instance, Ray Dalio and several others, that believe that international and emerging markets are bound for a pendulum swing to start performing stronger in the future. And so a good way to hedge this is to have a smaller percentage of your portfolio into international and emerging market stocks. Now, again, the 2-fund portfolio is good enough for you to start off with and to really have a strong portfolio that you can have for a lifetime. But when you start to introduce this, you're looking outside of the US and you're saying, how can I hedge myself even more and potentially receive higher returns, although understanding that historically it's been a little bit lower internationally as the US has outpaced in terms of total GDP growth and in terms of total stock market growth. So the next 2 stocks to add would be VXUS, Vanguard's total international stock market, and VWO, which is Vanguard's total emerging markets. Now, the international are some of the more established players. Think Europe, Japan, right? More established international markets. And the emerging markets, think more China, India, those types of emerging markets that you can invest in. And the general rule of thumb and recommendation is to have that be a smaller percentage of the stocks in your portfolio. So I'll just use a quick example. Let's say you're 25. You would put 25% into the total bond index, the BND. And then you would have 75% that would go into VTI in the two-fund portfolio, right? So 25% in bonds, 75% in VTI. Now, what you may want to do, though, if you're going into the four-fund, is take that 75% and not put all of it into VTI. Maybe you put 50% into VTI, the total US, and then you decide to put 12.5% into the international and 12.5% into emerging, or maybe even 15% in international and 10% in emerging. So you could have 25% in those bonds, you could have 50% in total US stock market, 15% in international, and 10% in emerging markets. Again, the exact amount that you want to put in is going to be relative to you, your risk, taking a look at it. I highly encourage you to not only take a look at the funds themselves, the ETFs themselves, but also go on the Bogleheads forum. There's a whole collection of people that literally want to help you and will help you for free in those forums, help map out a specific plan following the Bogleheads philosophy and strategy, which is having several index funds within your account. Now, if you're looking to take this one more layer deeper, right? So you've got total US stocks, total US bonds. You can add in international stocks and also emerging market stocks. There's two more that you might consider adding. The next is international bonds, which is bndx. Those are international bonds, and you can actually add that to get exposure to bonds outside of just the United States. So similar to how you can break up the amount that you put directly into the stocks, into US and international and emerging markets, you can do the same thing on the bond side. Now, instead of taking that 25% and all putting them all into US bonds, BND, let's say you could put 15% into US bonds and 10% into bndx, international bonds. I would weight in general more towards the United States. That's in general what is recommended within the Bogleheads. That's in general my philosophy, but again, you might differ in your philosophy. And again, some other people decide just to invest directly into the US stocks as well. And the final ETF that you may want to add is VNQ. That is Vanguard's Total Real Estate Fund, and that covers a wide collection of real estate, both in residential and commercial, that's going to allow you to have a slice of the United States real estate market. Now, especially during times of inflation, real estate does tend to perform better as the price of real assets outperforms. However, it's important to know that in the event of a housing crash, this could be adversely affected compared to stocks. So it's important just to keep those things in mind. But what you could do is you could take a portion of that stock side of the portfolio, let's say that's 75%, and maybe allocate 5 or 10% to VNQ, so you have exposure to the real estate market in addition to stocks, international stocks, and bonds, and potentially international bonds. So those are the 6 ETFs that you can decide to invest in. We of course have VTI, Total Stock Market Index. We also have BND, the Total US Bond Market Index. We have VXUS, the International Stock Index. Then we have VWO, the Emerging Markets Stock Index. Then we also have our bndx, our International Bond Market. And finally, we have VNQ, which is our total US real estate market. So you can decide where you want to put it. The general rule of thumb is your age in bonds and then the other in stocks. And that would also be inclusive of that real estate investment as well. And so then you can decide from there how much you want to slice the pie and where you want to put it in. An example of a portfolio might be the following. Let's say you're 25 and you put 15% into BND. You put 10% into bndx. So 15% into US bonds, 10% into international bonds. Then on the other side, you actually put 50% into VTI. So the vast majority of what you're doing is going into VTI, which is a total US stock index. Then from there, you put 10% into international, the VXUS. You put another 10% into emerging markets, the VWO, and you put another 5% into the real estate market, VNQ. But that's just an illustration of what you could put together and what you could do. Again, this is completely up to you. So you're gonna wanna look at this yourself and decide what portfolio makes the most sense for what you're investing in. But the big recommendation that I have is look at ETFs. It's a basket of stocks. Instead of picking individual stocks, there's lots of studies out there that show your ability, especially if you're not a professional investor, to pick individual stocks is oftentimes far superseded by just owning an index, not having to worry about it, dollar cost averaging in. All of these softwares have ways that you can automatically invest over time, right, without directly investing, as opposed to trying to pick and choose your own stocks, and then also having to worry about all the headache of that and the heartbreak of going up and down. You actually are able to have it invested in those index funds and then just rebalance your portfolio at least once a year. So an alternative to VNQ is to invest in an E-REIT like Fundrise. Now, Fundrise individually buys up a wide variety of different commercial and residential properties, and then allows you to own a share of those within their E-REIT funds. Now, one of the reasons I like it is that it's a tech-first company, and you can actually see all the details of all the investments that they're buying, and they're aiming to achieve more alpha results compared to VNQ, which is more following the total housing market and total commercial real estate market within the US, right? So that's gonna follow more of, in general, what the market is doing, whereas Fundrise is specifically looking to achieve better results, but again, there's always a risk that those results may actually underperform as well. Fundrise is another cool tool and option that you can use, again, especially during an inflationary time where the value of real assets are going up as opposed to cash money in the bank. Now, important thing to do during times of inflation is to max out contributions to every account you have access to, whether it be a 401k, a SEP IRA, an individual IRA account, Roth IRA, where you can actually pay taxes on it now and then get tax-free money in the future. Maxing out your Roth IRA, again, depending on your age and your details, you could be able to contribute up to $5,500 a year into that. You pay taxes now, but then as that money grows, let's say that money grows to $1 million over time, you can take that out tax-free in the future. Right? And so if you start investing in that now, it gives you a really good opportunity for you to grow your money long term and actually, pay taxes on it now and not pay in the future. So what you're able to do is max out your contributions to your Roth IRA, to your individual IRA, 401k, SEP account, whatever it happens to be. Again, consult your tax professional. They'll have a better idea of what tax advantage accounts you can max out. And I recommend looking into an HSA, which is a health savings account. We have a high deductible health insurance plan. You may be eligible for an HSA account where you can actually put money aside, either $3,500 or $7,000 per year if you're a family. You could put money aside and actually invest that money, and it can grow tax-free for use in any medical expenses you have. Now, this is not money you can use for personal or regular expenses, but you can actually grow through the stock market money that you may want to use for medical expenses if you need to. Again, you don't want to have to use that, but it's good to have that growing in the background. And finally, the best thing to invest in my opinion, is in yourself and your skills and your business if you have one. Whether or not you have a business, investing in yourself has the highest rate of return. Remember, the value of the dollars in your bank account is going down, but what's something you keep for a lifetime? The skills that you have and you attain. So whether you're working for a company and you're increasing your skills, you make yourself the most valuable employee. In a time of inflation, you want to be able to ensure that you have those skills so that you are indispensable at the company you work with. But then on the other side, you also want to make sure that if you have a business or you're thinking of launching a business, you're investing into that business itself. One of the best returns you can have is investing in yourself or in a business, because the business will give you far, far better returns than even 10 or 15% or the 9.62% we talked about with the I bonds right now. It's going to give you that ability to actually create and craft a business that can grow and possibly double, triple, quintuple, 10x the money that you put in, or even more, because you're investing money into an asset that you have, a business that can grow over time. Now, I actually have some resources on how to do that, and actually how you can build a business based around organic video like you're watching right now. It's our video clients training. It's completely free. It's down there in the description below. And on that training, I cover how you can build an entire business around organic video and attracting high-paying clients, and you can build it around your expertise, your passion, and your existing skills. Taking what you already have, turning it into a business, and attracting clients with organic video like this without spending a dime on ads. And so I have a full training on exactly how that works, how you can start building a business, earning a full-time income, or even scaling up to $10,000 a month or even more, actually having an organic-based video business. You can click the link down there in the description below if you want to learn how that works. It's a free training that walks you through step by step how our process works to attract high-paying clients on video. And then again, if you already have a business, investing in ways that that business can grow. We have our YouTube ads trainings and programs, we'll put those down below as well, but making investments in yourself is key. That's what I know that I love to do. I love to reinvest back into my own training, my own education, but also back into the business, back into the training and education of my team, the people that I have on my team, learning skills as a company that is going to allow us to grow, hit that next target, and really scale from there. And that, I believe, is one of the absolute best things you can invest in a time like this, is investing in yourself and your business. Thank you so much for watching this video. I hope you found this video valuable. Let me know in the comments down below if there's other investments that you're making right now and what you found most valuable about this video. Be sure to like the video, share it with somebody else that needs to see it, and subscribe for more videos. Right here, we talk about business, finance, we talk about mindset, YouTube ads, marketing, and more. Right here on this channel, we got regular content coming out every single week, and I will see you on the next video.